When you buy a mutual fund, you place the order without knowing what you'll pay. Not roughly, at all. The price is set hours later, after the market closes, and you're committed before it exists. That's not a quirk of one company. It's how the product is built. And there's a near identical product holding the very same basket of shares, where you know the price to the cent before you commit, which is the comparison this whole episode turns on. Pooled products are where a lot of ordinary people actually meet the securities industry, so the exam gives them real weight.
Erica here, and the SEC's definition is precise about what kind of thing a mutual fund is. A mutual fund is an SEC-registered open-end investment company that pools money from many investors.
Michael here. A company, not a pile of assets. That matters because you become a shareholder in the fund rather than a direct owner of what it holds.
And open-end means it can keep issuing new shares. There's no fixed number. Money comes in, shares are created. Money leaves, shares are redeemed.
Which is why you buy from the fund itself. The SEC says investors buy mutual fund shares from the fund itself or through a financial intermediary like a broker.
There's no other investor on the far side of your trade. The fund is your counterparty.
And it's worth being clear what pooling actually buys the investor, because that's the point of the whole product. A person with $200 can't sensibly own 400 different securities. Pooled with everybody else, they own a slice of all of them, and the diversification arrives with the first payment rather than after 20 years.
And the price is net asset value. The SEC says investors buy or sell mutual fund shares at the NAV per share, plus or minus applicable fees, and that NAV is typically calculated at the end of each business day.
End of each business day. One price, once, for everybody who ordered that day.
So an order placed at 10 in the morning and one placed at 3 in the afternoon get exactly the same price, and neither person knew it when they placed it. And the word redeemable is doing real work in that sentence because it's what open-end actually means in practice. You're not hunting for a buyer. The fund is obliged to take the shares back and hand you the value of your slice, which is a genuinely different promise from anything else in this section.
And going out is the mirror. Shares are redeemable, meaning you can sell them back to the fund at any time at the next calculated NAV, minus any redemption fees.
Isabella, is that not just a bad design? Every other product on this exam lets you see a price before you commit.
Real quick, because this next part matters to you. If any of this is helping, tap that like button, then hit subscribe and ring the bell so the next one finds you. Both are free and take about a second, but they tell the algorithm to show this to one more person who needs it. Erica called end-of-day pricing a bad design, and it's the right challenge because the answer explains the whole structure.
It needs someone who works on how these vehicles are actually constructed.
Professor Aturu studies how pooled investment vehicles are structured and priced, and picked out Erica's objection before we started.
Erica is right that it's unusual and wrong that it's careless. Ask what net asset value actually is. It's everything the fund owns minus what it owes divided by the shares outstanding. To produce that number, you need a current price for every single holding.
And you only have those once the market has stopped moving.
Precisely. A fund holding 400 securities can't know what it's worth at 11 in the morning without pricing 400 things that are still trading. The daily calculation isn't laziness. It's the first moment the number can honestly exist.
And there's a second reason, is there not, about who gets protected.
The more important one. If you could buy into a fund at yesterday's stale price after seeing today's market rise, you would be taking value directly from the people already in it. Pricing every order at the next calculated value removes that opportunity entirely.
So the thing that looks like a disadvantage to the buyer is a protection for the existing holders.
And you're one of those existing holders the moment after you buy. The rule that inconveniences you on the way in is the rule that protects your money every day afterwards.
That's a considerably better answer than I expected.
It's worth carrying because the exam tests the mechanism rather than the grumble. If an item asks what price a mutual fund order receives, the answer is the next calculated net asset value, and the reason is that the fund must price its holdings first.
And there's a term worth knowing for what we just described because questions use it. Pricing every order at the next calculated value rather than the last published one is called forward pricing. If an item asks which value a mutual fund order receives, the answer is always the next one, never the one already on the screen. Is there a genuine cost to the investor in all this?
And I wouldn't pretend otherwise. You can't react to intraday news, you can't set a limit price, and if the market moves violently after you order, you own that move whether you wanted it or not. For a long-term holder that's close to irrelevant, for anyone wanting control over execution, it's a real constraint, and that's exactly the gap the other product fills.
Professor Aturu, thank you. The rule that inconveniences you on the way and protecting you afterwards is the framing I'd want kept.
Now the product that fills that gap, and the comparison is cleaner than people expect because only one thing really changes.
An exchange-traded fund can hold the very same basket of securities as a mutual fund. The difference isn't what's inside it.
The difference is how you get in and out. The SEC is direct. Retail investors can buy and sell ETF shares only in market transactions. That's on a national stock exchange.
Only, which means you're not dealing with the fund at all. You're buying from another investor the way you would buy a share of any company.
So everything from episode 12 applies. That's a secondary market transaction and the fund receives nothing from it.
And the price follows from the venue. The SEC says retail investors buy and sell ETF shares at market prices, plus or minus applicable fees.
And there's one structural consequence of trading on an exchange worth naming. Because the fund isn't creating or destroying shares for a retail buyer, an ETF doesn't have to sell holdings to meet ordinary redemptions the way an open-end fund does. That difference is why the two behave differently under stress, even holding identical baskets.
Market prices continuously while the exchange is open. You see the number before you commit, and you can use a limit order like any other stock.
Which answers Erica's complaint from scene 1 exactly. Everything she wanted, the ETF structure provides.
And the exam mostly wants that one contrast. Mutual fund. From the fund. At the next calculated NAV once a day. ETF. On an exchange. At market price. All day.
2 sentences, and a great many questions fall out of them.
But that continuous market price introduces something a mutual fund investor never has to think about, and it's the last real idea in this episode.
Which is what happens when the price on the exchange and the value of what's inside the fund disagree. So what happens when the exchange price and the underlying value part company, which they can and do?
And this is the one genuine complication the ETF structure adds.
Professor Aturu is back with us for this.
The SEC states it plainly. An ETF's market price may be higher or lower than the ETF's net asset value per share. 2 different numbers describing the same fund at the same moment.
How can they disagree if the basket is right there?
Because the market price is set by supply and demand for the shares themselves, and the net asset value is set by the holdings. Those are 2 different forces. Usually they track closely, and there's a mechanism involving large institutions that pushes them back together. But nothing guarantees they're equal at the instant you press the button.
So how can the market price and the net asset value disagree if the basket is sitting right there? That's the part I couldn't make sense of the first time.
And the vocabulary for the gap is the same as the bond episodes.
Deliberately so, and it's worth noticing because it recurs across the whole exam. Trading above net asset value is a premium, below it's a discount. The same 2 words you met on a corporate bond, describing the same idea in a different product.
And a mutual fund investor is simply never exposed to this.
Never. They transact with the fund at net asset value by construction, so premium and discount can arise. That's the trade. The ETF buyer gets intraday control and accepts the possibility of paying slightly more than the holdings are worth. The mutual fund buyer gets the honest value and gives up the control.
Is one of those better?
Not in general, and I'd resist anyone who says otherwise flatly. For a monthly investor, putting away a fixed sum for 20 years, intraday pricing is worth nothing, and the discipline of one daily price is arguably a benefit. For somebody who needs to enter or exit at a specific level, the ETF is plainly the right instrument. The honest answer is that they suit different behavior, not different levels of sophistication.
And a practical instruction falls straight out of that, which is worth giving even though the exam only wants the concept. If you're buying an exchange-traded fund, look at the market price and the published net asset value together rather than at the price alone. The gap between them is information, and it costs nothing to check.
Professor Aturu, thank you. They suit different behavior rather than different levels of sophistication is a fairer summary than most of what gets written about this. So the routine, which is one question with everything else hanging off it.
Who is on the other side of the trade? If it's the fund itself, you're in a mutual fund. If it's another investor on an exchange, you're in an ETF.
And everything else follows. Dealing with the fund means net asset value once a day calculated after the close. Dealing on an exchange means market price continuously with limit orders available.
And only the exchange-traded one can trade away from its net asset value at a premium or a discount, because only it has a second price to disagree with.
And notice this episode restated 3 earlier ideas rather than introducing new ones. Secondary market from episode 12, premium and discount from the bond block, and pooling as diversification. Section 2 rewards recognizing the repeat far more than it rewards learning each product from scratch.
Which means a question mentioning a premium or discount on a fund has already told you it's an ETF.
There's a fair challenge to how cleanly we've drawn that line, though.
Make it, because I'd rather it came from us.
We've described 2 products, and the pooled fund world is wider than that. There are closed-end funds that trade on exchanges and aren't ETFs, and unit investment trusts, and the SEC's own material mentions that some ETFs register as trusts rather than as open-end companies. A candidate who leaves with a strict 2-box model will meet something that fits neither.
And the counter is that the 2-box model answers the overwhelming majority of items at this level, and the exceptions are recognizable precisely because they break a rule you already know.
Which is how I'd leave it. Learn the contrast properly and treat anything that doesn't fit as a signal to slow down rather than as a reason to distrust the model.
And one practical note for the drills. Fund questions describe a transaction rather than naming the product, so read for the venue first. The words on an exchange or at market price settle it before you've read the rest of the sentence.
Next time we stay with pooled products and look at how they charge you, loads, expense ratios, and share classes, which is where a lot of real money quietly goes. If one thing survives today, make it the counterparty question. Buying from the fund gets you one honest price a day. Buying on an exchange gets you control and the possibility of paying a premium.
Same basket, different plumbing.
If you're working toward this exam, subscribing keeps the course arriving in order, and the free practice sets on the site now cover the pooled product items. So before you go, tell me, did you know you order a mutual fund before the price exists? Go and ask the counterparty question on 10 practice items. This is Isabella, and I will see you in episode 28.